Okay, let's unpack this. We've got some really important material in front of us today, diving deep into the world of tax-exempt organizations.
hmm
We're specifically zeroing in on that status most people know, Section 501c3, and also this concept that, well, often surprises people, unrelated business income.
Indeed. And the sources we have here, they lay out a really detailed roadmap. Yeah, the rigorous requirements these not-for-profit entities have to meet.
Right, not just to get the status, but to keep it.
Exactly, to
Yeah.
maintain it over time.
Yeah.
And they also clearly define the conditions under which even a tax-exempt organization might actually end up owing taxes.
Right. So look, if you've ever interacted with, maybe donated to, worked for, or, served on the board of a nonprofit like a charity, a school, a church, perhaps a foundation, or even if you're just curious about how these organizations tick, sort of under the hood of the tax code, this deep dive is definitely for you.
hmm
Our mission really, based on this material, is to pull out the essential knowledge. We want to help you understand the fundamental rules that govern these entities, their finances, without getting completely lost in, dense legalese.
Yeah, cut through the jargon.
Exactly. Let's jump straight into what the source material tells us about the very foundation. What is a tax-exempt organization?
Well, what's fascinating right from the start is how the government's recognition is tied to both structure and purpose. It's not just one or the other.
So starting right at the beginning then, how does our source material define it? At its core, what is this status?
The source gives a very clear, concise definition. It says a tax-exempt organization is fundamentally a not-for-profit organization that qualifies for exemption from federal income tax.
Okay, simple enough.
And it immediately points out that the most common type, the one everyone thinks of, and the main focus here, is the Section 501c3 charitable organization. So this classification basically means the government recognizes that this entity serves a public good, could be charitable, educational, religious, scientific, you name it, in a way that justifies relieving it from that federal income tax burden that regular for-profit businesses face.
Okay, so 501c3 is the big one. The source doesn't just define it, though. It spells out the absolute must-meet requirements, doesn't it? Things an organization needs to satisfy to get the status, and crucially, to keep it.
Yes, absolutely.
Can you walk us through what the source identifies as these essential conditions, these sort of foundational pillars?
Definitely. The source lays out 4 core requirements that an organization absolutely must satisfy to qualify under 501c3. Think of them as like the non-negotiable gatekeepers.
Okay.
First pillar, the organization's structure. It has to be organized as a specific type of legal entity. Can't just be anything.
Got it. Structure.
Second, its purpose. It absolutely must have an exempt purpose as defined by the law. We'll get into what those are.
Exempt pro.
Third, and this is really crucial for the nonprofit idea, no private benefit allowed. The organization cannot be primarily operated for the gain of individuals or, private interests.
No private pockets getting lined.
Exactly. And the fourth pillar involves some pretty significant restrictions, actually a complete prohibition in one area, on political campaign activity and legislative lobbying.
Ah, the political stuff. Always tricky.
These 4 points, according to the source, they form the basic qualifying framework. You need all 4.
Those requirements really do sound like they're designed to draw a very clear line, don't they? Between something truly serving the public or a community benefit and, well, something else that might just be a business or a private club.
That's precisely the intent, it seems.
Okay, let's dig into each of those pillars then, starting with the first one, the structure requirement. What exactly does our source say about how a 501c3 has to be legally organized?
The source is quite specific here. It lists the acceptable legal forms. It states pretty unequivocally that a Section 501c3 organization must be organized as a corporation, unincorporated association, or trust.
Corporation, unincorporated association, or trust?
Okay, and it adds an important clarification about corporations. It notes that this includes LLCs, limited liability companies,
Ah, interesting.
but only, and this is key, if structured appropriately to meet all the other 501c3 requirements.
Yeah.
So just being an LLC isn't automatically enough. It has to, function like a nonprofit corporation for tax purposes.
That clarifies things. So it's not like any random group of people can just decide they're a 501c3. There has to be a recognized legal structure.
Correct.
The mention of an unincorporated association is interesting, though. What does the source say defines that? It sounds less formal than a corporation.
It can be. The source gives a helpful definition. It describes it as an unincorporated group of 2 or more persons joined by mutual consent for a common lawful purpose, whether organized for profit or not.
2 or more people, mutual consent, common purpose.
Right. And the key part is that this structure doesn't necessarily demand the same level of formality as, say, filing articles of incorporation with the state right away.
Did the source give an example? I think I remember something about neighbors.
Did, yeah. A very tangible example.
Yeah.
A group of neighbors pooling resources to save a local library.
Right.
That illustrates that a collective, organized effort, even without that formal corporate charter from day one, can potentially meet the structural requirement, as long as they have a clear purpose and some kind of governance structure that fits the other rules, of course.
So it emphasizes being organized with a shared goal,
Yeah.
not necessarily heavily incorporated from the get-go.
Exactly. It's about being an entity, a collective.
And the source is also clear about what structures don't qualify, which helps define the boundaries.
Yes, very clear on that. For absolute clarity, the source explicitly states that sole proprietorships, partnerships, and individuals do not qualify under Section 501c3.
So you as an individual doing good work, that doesn't make you a 501c3.
No, it has to be a collective, formally recognized entity, whether it's that corporation, a trust, or that organized association. The exemption goes to the organization, not just the good intentions of individuals.
Got it. It's about the established collective entity. Okay, moving to the second pillar. Having an exempt purpose. The source listed specific categories. What are those again, and what does the source mean by saying an organization must be organized and operated exclusively for these?
Right, the exempt purposes. The source provides a specific list of 8 categories. These are the only recognized reasons, essentially, for getting this 501c3 status. The list includes charitable, religious, scientific, testing for public safety, literary, educational.
Kind of the classic ones you think of.
Exactly. Then there's fostering national or international amateur sports competition, with a specific catch we should talk about. And finally, prevention of cruelty to children or animals.
Those are the buckets the mission has to fit into. But that phrase the source uses, organized and operated exclusively, that sounds incredibly strict, like zero deviation allowed.
It does sound absolute, doesn't it? Exclusively makes you think, okay, you can only do this one thing, or every single activity must perfectly match.
Yeah.
However, while the source material itself doesn't dive super deep into the legal nuances here, in practice, exclusively is generally understood to mean something closer to primarily.
Okay. Primarily.
Yes. The organization's main focus, its core mission, and the overwhelming majority of its activities have to genuinely align with one or more of those listed purposes. The fundamental reason for its existence and its day-to-day operations must clearly serve one of those public goods. It can't have like a significant non-exempt purpose running alongside its main mission.
That makes more practical sense. It's about the primary identity and function. Now, you mentioned a specific catch, a caveat for amateur sports competition. What was that detail?
Yes, and this is a great illustration of how precise these rules can be. The source clarifies that fostering amateur sports only qualifies if none of its activities involve providing athletic facilities or equipment.
Really? So they can organize the league, but not own the field or provide the balls?
That's the implication. It suggests promoting the competition itself, maybe organizing events, supporting athletes. That might be okay. But the moment the organization starts owning or operating the gyms, the fields, the pools, or even just providing the equipment.
It could fall outside that specific purpose, or at least raise questions.
Exactly. It could potentially jeopardize qualification under that specific purpose, or at least trigger scrutiny. It really highlights how narrow some of these definitions can be in the real world.
Fascinating level of detail. Okay, structure and purpose covered. Pillar number 3 feels like the absolute core of being not-for-profit. No private benefit allowed.
This isn't just a pillar. You could argue it's the bedrock. It's what fundamentally distinguishes a true charity or public benefit organization from a private enterprise just wearing a nonprofit hat. The source states this restriction with absolute clarity. A Section 501c3 must not be organized or operated for the benefit of private interests, such as the creator's family or shareholders of the organization. That's the fundamental test. Is it serving the public good or private individuals or entities?
So you can't set up a nonprofit, even with a genuinely good cause on the surface, and then use it as a vehicle to enrich yourself, your family, your business partners.
Precisely not. And the source drives this home by adding, no part of the organization's net earnings may benefit any person having a personal and private interest in the activities of the organization.
Net earnings. So any money it makes beyond expenses.
Right. Any financial gains or surplus the organization generates must be plowed back into furthering its exempt purpose. It can't be diverted to benefit individuals who have a personal stake, insiders, founders, board members, their families, beyond, of course, reasonable compensation for actual services rendered.
Yeah.
Though the source doesn't get into the weeds here on what reasonable compensation means, which is a whole complex area in itself.
Sure. But the core idea is clear. The organization's assets and income are dedicated to the public mission, not private enrichment.
Exactly. This rule is the primary shield against abusing the tax-exempt status. It's fundamental for public trust.
Absolutely vital. Okay, that makes complete sense. Now, the final requirement, this is perhaps the one that gets the most attention, maybe the most complex. The restrictions on political and legislative activities. The source breaks this down into two distinct areas, right?
Yes, and it's really crucial to understand these as separate rules with different levels of strictness. It's
Yeah.
not all lumped together. First, you have political campaign activities. Second, you have legislative activities, which is basically lobbying.
Okay, campaign activity first. What's the rule there?
For political campaign activities, the source uses very strong, very prohibitory language. It states that 501c organizations are prohibited from directly or indirectly participating in any political campaign for or against any candidate for elective public office.
Prohibited. That sounds like a total ban. Zero exceptions for candidate politics.
Based on the source's wording here, yes, it's an absolute prohibition, no wiggle room indicated.
Wow.
And the source clarifies what this includes. It means things like contributions to political campaign funds, or public statements of position made on behalf of the organization for or against any candidate for public office.
So the organization itself cannot endorse or oppose someone running for office at all.
Correct. The idea behind this rule is to ensure that these entities, which get a public subsidy through tax exemption, remain neutral in electoral contests. They need to stay focused on their exempt purpose, not on trying to get specific people elected or defeated, strictly nonpartisan when it comes to candidates.
But I think the source mentioned something about voter education. Is there a carve-out there?
Ah, yes, absolutely. And this is a very important distinction the source highlights. While direct candidate campaigning is totally banned, the source notes that certain voter education or registration activities are not prohibited political campaign activities if they are conducted in an unbiased, nonpartisan manner. That's a critical condition.
Unbiased and nonpartisan.
Exactly. So a 501c3 can engage in activities that inform voters about issues or help them register to vote, but only if it's done in a way that is completely neutral. It can't favor or oppose any specific candidate or political party. The moment it tilts, the moment it starts looking like it's trying to influence who wins,
It crosses the line.
crosses that line. It's about promoting civic engagement neutrally, not trying to sway an election outcome.
That is a really fine but incredibly important line to walk for any organization working on public issues. Okay, so that's political campaigns' complete ban on supporting or opposing candidates. What about the other part? Legislative activities or lobbying? How does the source describe that restriction?
For lobbying, the rule is framed quite differently. It indicates a limitation, not a total ban. The source states that an organization does not qualify for 501c3 status if a substantial part of its activities is attempting to influence legislation, lobbying.
Substantial part. Okay, that phrasing immediately jumps out as different from the absolute prohibition on campaign work. It's not zero, but it can't be. Well, substantial.
Precisely. It's not a complete prohibition. There's some room, but not unlimited room. And the source defines what counts as legislation in this context. It's about actions of Congress, state legislatures, or local councils with respect to acts, bills, resolutions, and similar items. So it's focused on the lawmaking process in legislative bodies.
Okay, so trying to get a bill passed or defeated in Congress or the state house or city council that is lobbying under this rule. But what about other kinds of advocacy, like trying to influence a new regulation from a government agency or maybe advocating for or against a judicial nominee?
That's a great question, and based on the source's specific definition of legislation here, those activities influencing executive branch regulations or judicial appointments would not typically be considered legislative activity, subject to this substantial part test.
Really?
Yes. The source explicitly clarifies that it does not include actions by executive, judicial, or administrative bodies. So the lobbying restriction that comes with 501c status is quite narrowly focused on influencing the actions of legislative bodies. Other types of advocacy might be permissible.
That's a huge distinction. Wow, okay. And does the source define what attempting to influence legislation actually involves? Like, what actions count?
Yes, it gives examples. It says it includes things like contacting or urging the public to contact members or employees of a legislative body for the purpose of proposing, supporting, or opposing legislation,
Okay, direct contact.
or advocating the adoption or rejection of certain legislation.
So sending out an email blast saying, call your senator about Bill X, that would absolutely be attempting to influence legislation. That's lobbying under this rule.
Yes, that's a classic example of what would count.
This substantial part test for lobbying, though. Compared to the clear no on candidate activity, it must be pretty challenging for organizations to figure out where that line is. How do you measure substantial? Does the source give any guidance?
It absolutely introduces complexity, a definite gray area. And no, the source material here does not provide a specific percentage or a dollar amount or any kind of hard and fast rule for what constitutes substantial.
So organizations are left to figure it out.
Essentially, yes. This lack of a bright line test means organizations have to be really careful. They need to monitor their lobbying activities, how much time, how much money, how much effort is going into it relative to their overall activities and budget. The implication is clear. A small, truly insubstantial amount of lobbying is probably okay. But if lobbying becomes a significant focus, if it consumes a large chunk of resources or staff time,
It risks crossing that substantial line and jeopardizing their 501c status.
exactly. Unlike the zero tolerance for candidate work, lobbying has this fuzzier threshold based on scale. It forces organizations to make careful judgments, keep meticulous records, and often seek legal counsel to navigate it.
Okay, so summing up these pillars. To get and keep 501c status, an organization needs the right legal structure, must be organized and primarily operated for a specific exempt purpose, must absolutely ensure no private benefit happens, and then be completely hands-off regarding political campaigns for candidates while keeping any legislative lobbying activity to an insubstantial part of their overall work.
That's a great summary of the core requirements outlined in the source.
And understanding these requirements leads right into the next logical question. What happens if they slip up?
Precisely. What are the risks?
Our source explicitly lists ways that this valuable tax-exempt status can actually be lost.
Yes, it provides a very clear checklist, essentially, of the events or actions that may cause a Section 501c3 organization to lose its tax-exempt status. And as you expect, these points largely mirror the qualification requirements we just went through, but framed as violations, failing to maintain compliance.
So, for instance, if they start engaging in activities that fall outside their approved exempt purpose, that would be a problem.
A big problem. The source lists this clearly. The organization engages in activities that are not related to its stated tax-exempt purpose. And then it adds an important parenthetical.
Friction to suit.
Unless unrelated activities are an insubstantial part of its total activities.
Ah, that insubstantial idea again.
Right. It echoes the organized and operated exclusively primarily concept. If an organization starts spending significant time, money, or resources on activities that just aren't part of its core mission, even if those activities aren't illegal or for private gain, it risks losing its status if those unrelated activities become more than just a tiny, insignificant part of its overall operations. It highlights that the activities themselves, not just the income from them, must primarily serve the exempt purpose.
Okay. And taking that a step further, what if those unrelated activities don't just become substantial, but actually seem to become the main thing the organization is doing?
Well, that's an even clearer path to losing status listed explicitly by the source. The organization operates for the primary purpose of conducting a trade or business that is not related to the organization's tax-exempt purpose.
So if the side hustle becomes the main gig.
Exactly. If a nonprofit starts, say, a commercial venture that's completely disconnected from its charitable mission, and that venture grows to become its primary activity, overshadowing the original purpose, well, then it's no longer operating primarily for its exempt purpose. That's the fundamental basis for the tax exemption in the first place. The tail can't wag the dog. The exempt purpose has to remain central.
Makes sense. And predictably, violating that core principle of no private benefit, that's also a trigger for losing status.
Yes, another clear risk highlighted by the source. The activities or earnings of the organization benefit any private interest. If an organization lets its operations, its assets, its revenue improperly benefit individuals or private entities, maybe through excessive salaries, sweetheart deals, diverting funds, it's a direct violation of that public benefit principle.
And that risks losing the status.
Absolutely.
Yeah.
The IRS watches for this closely. Violations here can bring severe consequences, not just loss of status, but potentially penalties too.
Okay. What about those political and legislative restrictions we talked about? Violations there also lead straight to losing status.
Yes, absolutely. Failing to stick to those rules is a direct path to revocation. The source lists the violations that mirror the restrictions. First, the organization participates in political campaigns for or against a candidate for elective public office. As we discussed, any participation is banned, so any participation risks status loss.
Zero tolerance means zero tolerance.
Right. And second, the organization engages in lobbying activities attempting to influence legislation unless the lobbying activities are an insubstantial part of its total activities.
So again, just like with qualifying initially, the substantial part test applies to lobbying when it comes to keeping the status, but any candidate campaign activity is an immediate danger zone.
Exactly. It's a continuous requirement. Organizations have to constantly monitor lobbying to ensure it stays insubstantial while maintaining that complete firewall against candidate politics. Crossing either line jeopardizes the organization's status.
And the final point listed in the source for losing status. It seems less about the mission or the big policy rules and more about just paperwork.
It is, and honestly, it's a critical point that organizations, especially smaller ones, cannot afford to mess up. The source lists. The organization fails to satisfy its annual filing requirements, Form 990 returns.
Just not filing the forms.
Yes, simply neglecting to file the required annual informational return with the IRS. Usually it's Form 990, or maybe the 990EZ or 990N, depending on the size, for 3 consecutive years, can result in automatic revocation of tax-exempt status.
Automatic. Wow.
Yeah, the IRS can just pull the plug administratively.
Right.
This can happen even if the organization is otherwise doing everything perfectly right according to all the other rules we discussed. It really underscores the absolute necessity of basic administrative compliance and good governance. Don't ignore the paperwork.
That is a really sobering reminder, isn't it? You could have the most amazing mission, run your programs perfectly, follow all the rules about politics and private benefit, but if you just fail to file the right form for 3 years, it could all be undone.
It really highlights that maintaining status isn't just about what you do programmatically. It's also about fulfilling your basic reporting obligations to the government. It's their mechanism for oversight, for transparency.
And the penalty for failing that basic requirement is severe, losing the exemption itself.
Precisely.
Okay, so we've covered how organizations get the 501c status, how they keep it by following those key rules, and importantly, how they can lose it, including through simple noncompliance. Now, let's pivot to that other concept we mentioned at the start, the one that often catches people off guard, unrelated business income, or UBI. Our source material indicates that even a fully qualified tax-exempt organization might still owe income tax on some of its earnings.
That's right. And this is a really important distinction for everyone involved with nonprofits to grasp. Tax-exempt status means the organization is exempt from federal income tax on income that is related to its exempt purpose.
Okay, income from the mission work.
Yes, but that exemption doesn't automatically cover all income from any source. The source clarifies this point well. Although an organization may have tax-exempt status, it may be subject to regular corporate income tax on income from a business enterprise that is not related to its tax-exempt purpose, UBI.
So if a charity or maybe a university or even a church starts engaging in activities that look and feel like a regular for-profit business, selling things, providing services for a fee, and that business isn't directly tied to their core mission, the income from that specific activity could be taxed, just like a regular company's profits.
Exactly. That's the core idea behind UBI. It's often described as trying to level the playing field. The goal is to prevent nonprofits from having an unfair competitive advantage over regular for-profit businesses simply because of their tax status, especially when they're competing in the same commercial marketplace. If both are selling the same product or service, why should one pay income tax and the other not, if the activity isn't related to the nonprofit's mission?
That makes sense from a fairness perspective. So how does the source define UBI? How do you know if income falls into this taxable category?
The source gives a very specific definition. It's actually a 3-part test. And crucially, income is considered UBI only if it meets all 3 of these conditions simultaneously. The source uses the word "and," which means all 3 criteria must be satisfied.
Okay, what are the 3 parts?
The 3 parts are: 1, the income must be derived from an activity that constitutes a trade or business.
Okay, it has to look like a business activity.
2, that trade or business activity must be regularly carried on.
Regularly carried on, not just a one-off thing.
And 3, the activity, the trade or business itself, must not be substantially related to the organization's tax-exempt purpose.
Not substantially related. Okay, let's break those down a bit. First, activity that constitutes a trade or business. What does that mean here?
Well, the source doesn't give an exhaustive legal definition in this excerpt, but the general implication is any activity conducted with the primary purpose of earning income or profit. It involves engaging in activities typical of commercial businesses, selling goods, providing services for a fee on an ongoing basis. It's about the intent and the manner of the activity.
Okay. And the second part, regularly carried on. Does that mean daily, weekly? What's the threshold?
Again, the source doesn't provide a precise number, like more than X times per year. But regularly carried on is meant to distinguish ongoing, continuous business activity from things that are merely sporadic, occasional, or maybe seasonal fundraising events.
So, like you said, an annual bake sale probably isn't regularly carried on.
Likely not. But if that same nonprofit opens a retail bakery that's open 5 days a week, year-round, that is regularly carried on. It's about the frequency, the continuity, and the manner in which the activity is pursued, comparing it to similar commercial activities.
Got it. Now, the third part seems potentially the trickiest, not substantially related. How does an organization figure out if its business activity is or is not substantially related to its exempt purpose based on what the source tells us?
This is often the most debated part of the test. While the source doesn't give a long definition here, the underlying principle is that the business activity itself must contribute importantly to achieving the organization's exempt purposes in some way other than just generating money.
Okay, so it's not enough that the profits from the business are used to fund the mission.
Correct. That's generally not sufficient for the activity itself to be considered substantially related. The activity has to have a direct causal relationship to accomplishing the exempt purpose. Think about it this way. If a science museum runs a gift shop, and that gift shop primarily sells science kits, educational toys related to exhibits, books about science, things that enhance the visitor's educational experience, that activity itself, selling those items, arguably contributes importantly to the museum's educational mission. So it might be considered substantially related.
Right, extends the mission.
But if that same science museum decided to open, say, a large online store selling general household goods, clothing, electronics, even if 100% of the profits went back into funding the museum's exhibits, the activity of selling those unrelated goods doesn't directly contribute to the scientific or educational purpose. That would likely be considered not substantially related.
Okay, that's a really helpful distinction. It's about the nature of the business activity itself and its direct connection to furthering the mission, not just where the profits end up.
Precisely. That's the key conceptual difference.
Okay, so that's the general three-part rule for identifying UBI, trade, or business, regularly carried on and not substantially related. But then the source goes on to list quite a few exceptions, right? Specific types of activities and specific types of income that are excluded from being UBI, even if they might seem to meet parts of that test.
Yes, and these exclusions are really important for nonprofits to understand because they carve out safe harbors. First, the source lists specific activities that are statutorily excluded from the definition of an unrelated trade or business. Income from these activities is generally not considered UBI, even if they look like a business.
Okay, what activities are on that exclusion list?
It's a pretty diverse list. It includes, first, bingo games, but with specific caveats noted in the source. They have to be legal where conducted, and the type of bingo has to be the kind generally conducted by nonprofits in that area. So maybe not high-stakes casino-style bingo.
Okay, bingo with rules.
Second, activity conducted primarily for the convenience of the organization's members, students, patients, or employees. This is a big one. Think of a university bookstore, mainly serving students and faculty, or a hospital gift shop or cafeteria, mainly for patients, visitors, and staff. These are seen as directly supporting the people connected to the mission.
The convenience exception. Got it.
Third, convention or trade show activity. Income from activities related to organizing and conducting conventions or trade shows, particularly for members or within the industry related to the exempt purpose, is typically excluded.
Okay.
Fourth, the exchange or rental of membership lists. This is a specific carve-out allowing nonprofits, like charities or educational institutions, to rent or trade their donor or member lists with other similar organizations without triggering UBI.
Interesting. Mailing list swaps are okay.
Fifth, the sale of merchandise received as gifts or contributions. The source explicitly uses the example of a thrift shop here. Selling goods that were donated to the organization is not treated as an unrelated business. even if it's run like a regular store. It's seen as liquidating donated assets for the mission.
So Goodwill or Salvation Army stores, that kind of thing.
Exactly.
Yeah.
Sixth, the sale of articles made by disabled persons as part of their rehabilitation. This activity is clearly excluded because the work itself is directly tied to a charitable or rehabilitative purpose.
Right. The activity itself is the mission.
And seventh, this is another significant one, activity where substantially all the work is performed by unpaid volunteer workers. If a business-like activity relies almost entirely on volunteers.
Like a charity bake sale or maybe a fundraising car wash run by volunteers?
Precisely. If volunteers are doing essentially all the labor, the income generated is generally excluded from UBI. This acknowledges the huge role of volunteerism in the sector and doesn't penalize traditional volunteer-driven fundraising efforts.
That's a fascinating list of excluded activities. As you point in, the source doesn't always spell out the why for each, but you can sort of see the logic. The convenience clause lets organizations serve their own people. The volunteer exception protects traditional fundraising. Selling donated goods is core to many charities.
Exactly. It seems these activity exclusions are designed to permit certain income-generating activities that are either very closely tied to the mission population, like convenience, rehabilitation, rely heavily on donated resources, goods, volunteer labor, or are considered traditional nonprofit practices, perhaps conventions, list exchanges, bingo, without hitting them with the UBI tax. They recognize that not all money making by nonprofits is the same as commercial enterprise.
Okay, that makes sense. So in addition to those specific activities being excluded, the source also lists certain types of income that are generally excluded from UBI, almost regardless of the activity that generated them, particularly if they fall into passive categories.
Yes, this is a separate, very important set of exclusions, often called the passive income exclusions. These are income streams that typically don't come from actively running a commercial trade or business day to day. Because they're considered passive investments or returns on assets, the income is generally not subject to UBI tax.
Okay, what types of income fall under this passive umbrella, according to the source?
The source lists several key types. First, dividends, intracredital annuities, and other investment income. This is huge for organizations with endowments or savings. Income from typical investments, stocks, bonds, mutual funds, CDs, bank interest is generally excluded from UBI.
Standard investment earnings.
Second, royalties. This includes income received for the use of the organization's intangible property rights, like licensing its name or logo, getting payments for a patent, or book royalties, generally excluded.
Okay.
Third, rents from real property. This is very significant for nonprofits that own buildings or land. Basic rent received from leasing out real estate is usually excluded. However, the source flags some important exceptions here.
Ah, catches to watch out for.
Yes. This exclusion does not apply if personal services are also provided, along with the rent. This means if the nonprofit landlord is providing significant services to the tenant beyond standard maintenance and utilities, things like regular cleaning of the leased space, maybe specific security services, catering, services that benefit the tenant personally rather than just maintaining the property that can make the rental income taxable UBI. It starts looking more like running a hotel or serviced office.
Okay, so providing extra services beyond just being a landlord can taint the rental income. What's the other exception?
The other exception is if the lease covers both real property, the space, and personal property, like furniture, equipment, and the rent attributable to the personal property is more than 50% of the total rent received under the lease.
So if you're mostly renting out, say, furnished offices or lab equipment, and the value of renting this stuff is more than the value of renting the space.
Exactly. In that situation, the source indicates the entire rental income stream, both from the real estate and the personal property, could become taxable UBI. So you have to be careful with leases that bundle significant amounts of personal property with real estate, but standard passive rent from an unfurnished office or building, generally excluded.
Got it. Rents are excluded unless you provide too many services or rent out too much stuff along with the space. What else is excluded?
Fourth, income from research conducted by a college, university, or hospital.
Yeah.
This is a specific exclusion tailored to these types of exempt organizations, acknowledging that research is often integral to their missions, even if it's funded by outside parties.
Okay, specific rule for them.
And fifth, gains and losses from the disposition of property that was not held primarily for sale to customers. This generally covers capital gains. So if a nonprofit sells a building it used as its headquarters, or sells stocks or bonds from its investment portfolio, the gain or loss is typically excluded from UBI. This distinguishes it from the profit made by a business that's regularly selling inventory goods held primarily for sale.
So selling off capital assets is different from running a retail business.
Correct.
Okay, so summing up the passive income exclusions. If a nonprofit has an endowment throwing off dividends and interest, or they own a building and just collect basic rent, or they get royalties from licensing their name according to the source, these income streams are generally not considered UBI and wouldn't trigger income tax.
That's generally correct. According to the source, these common passive income types fall under the exclusions. But always remember those tricky exceptions for rents providing extra services or bundling too much personal property can flip it into UBI territory.
Right. Details matter. And selling assets they held for use or investment, not inventory, also generates excluded income.
Yes, gains or losses from selling capital assets are typically excluded, distinguishing them from regular business operating income.
Okay. Now, finally, the source briefly mentioned a different category of tax-exempt organizations' membership groups, like social clubs or maybe homeowners associations. They operate under different tax rules than 501c public charities, right? How does their taxable income work differently according to this material?
Yes, the source points out that these types of organizations, which are usually exempt under different sections of the tax code like 501c7 for social clubs, have a distinct framework for figuring out what's taxable. The source says they are usually taxed on all gross income, less deductions directly connected with producing that income, but not including exempt function income.
Okay, so everything is potentially taxable except something called exempt function income. How does the source define that for these membership groups?
For these specific types of membership organizations, the source defines exempt function income as gross income from dues, fees, charges, or similar items paid by members for the goods, facilities, or services provided to members and their families and guests.
Ah, okay. So for a social club, like a golf club or a fraternity or maybe an HOA, the money they get from their own members' dues, fees for using the facilities, charges for member events, that income, which relates directly to serving their members, is their tax-exempt income.
That's right. That's income from their core exempt function, which is serving their membership base.
But essentially, any income they earn from outside sources, like from non-members or from activities not directly serving the members and their guests, maybe renting out the club ballroom for a wedding to the general public, or income from investments they hold, that income would likely be taxable, potentially offset only by the direct expenses tied to earning that specific income.
That is exactly the implication from the source's description. Income derived directly from providing services or facilities to the members and their families' guests via dues, fees, etc. That's not taxed. But income generated from external sources or from activities that benefit non-members is generally subject to tax. It reflects their much narrower exempt purpose benefiting a specific group of members compared to a 501c3 public charity, which must serve a broader public good. It's a different model designed for those kinds of private membership organizations.
Wow. Okay. We have truly covered a lot of ground here.
Yeah.
We've gone from the absolute basics, the definition and structure needed for a 501c3. We meticulously broke down those four essential pillars: structure, exempt purpose, no private benefit, and those tricky political and lobbying rules. Then we looked at the various ways an organization can actually lose that precious tax-exempt status, including that really critical administrative point about just filing your forms.
Did I forget the paperwork?
Definitely not. And then we delved into the whole complex world of unrelated business income, defining what it is with that three-part test, listing all those specific activity exclusions like volunteer work and thrift shops, detailing the excluded types of passive income like dividends and basic rent, before finally touching on how the rules differ for membership organizations.
It really does underscore a key takeaway, doesn't it? While tax exemption is this incredible benefit for nonprofits, it lets them pour resources into their mission without that heavy tax burden.
Yeah.
It absolutely comes with significant legal responsibilities. There are complex rules that demand careful understanding and, frankly, constant navigation.
Yeah, it's not automatic or simple.
No. Maintaining compliance with all these requirements we discussed around the exempt purpose, avoiding any hint of private benefit, meticulously adhering to those political and legislative restrictions, and then correctly identifying and potentially paying tax on unrelated business income, these are all absolutely critical. They're vital for an organization's long-term health, its reputation, and its fundamental ability to keep doing its work.
Absolutely. It's so clear from this material that running a successful nonprofit isn't just about having passion for the cause, is it? It's equally about, well, meticulous adherence to a very detailed legal and regulatory framework. A framework designed ultimately to ensure these organizations really do operate for the public good they claim to serve.
Well said. And as the source reminded us so starkly, even those seemingly mundane administrative tasks, like filing the annual Form 990 on time, they aren't just bureaucratic hoops. They are non-negotiable requirements for staying in the game, for maintaining that tax-exempt status.
This deep dive into the source material has certainly shown a bright light on the complexities, the responsibilities, but also the structure that defines the world of tax-exempt organizations.
Indeed it has. And considering those detailed restrictions we discussed, especially on political campaign activities, and that careful, sometimes fuzzy line organizations have to walk regarding legislative lobbying, it really does raise an important final question for you, our listener, to think about. Given this legal framework, which actively limits overt political and legislative action for 501c3s, how do charities and foundations effectively advocate for the very systemic changes that are often needed to truly address the root causes of the issues they're dedicated to serving? Is a significant challenge, a tension built right into the structure itself. How do they navigate that?